Today we're going to be. Thanks everyone for joining us today. Today we're going to be talking all about interest rates.
Do it.
To begin, my name is Carmelo Buttice. I'm the mortgage agent at yourmortgageyourway.ca. I've been doing mortgages for 20 years. I began my career as a mortgage underwriter, and I have experience working with both the big banks and the small banks. The co-host Alex, again, I apologize, I don't have a slide for you, but
That's fine.
you want to introduce yourself?
Sure. Alex Waniecki from Remax Condos Plus. Over 10 years in the condo industry. Been a real estate investor since 2013. And yeah, that's just a little bit about myself. So Carmelo, why don't you take it away with the presentation here?
So today we're going to be talking all about interest rates. The first thing I want to do is kind of explain what the difference is with the different interest rates are when it comes to getting a mortgage. Everybody knows and familiar with a fixed rate. Everybody hears the term variable rate, but have you heard of an adjustable rate mortgage or adjustable rates period? Because it's not necessarily only mortgages. So the first thing I want to do is kind of explain the difference between the three rates.
Okay. Yeah, I haven't heard of adjustable rates. Go ahead.
Well, again, Alex, you and a lot of people really haven't, but they probably understand what it is. So a fixed rate mortgage is just an interest rate. The interest rate remains constant or fixed throughout the entire term of the loan or mortgage, because this is also for loans. Now, Alex, an adjustable rate mortgage is the interest rate can increase or decrease, and as interest rates change, so do the loan or the mortgage payments change.
Mm-hmm.
That sounds like variable.
Well, that's a good point, Dave. But again, an actual variable rate is a mortgage or a loan where the interest rate can increase or decrease. However, the loan or the mortgage payments stay the same. Now, a lot of people, I know with getting the mortgage, I work with so many different lenders. Communication is always the variable, right? Because that's how the public knows the social media, television, even when you go online trying to learn about interest rates, it's always focused on fixed and variable. But the variable, there's actually two different parts, and it's either an adjustable rate where as the interest rates change, your payments change, or there are a lot of a few banks, more than a few banks out there, where the variable rate changes, but the payments stay the same. So the first thing I wanted to kind of do is differentiate between the two.
Okay.
Alex, listening to this, do you have a better understanding between the three different interest rates?
So familiar with fixed and variable, it sounds to me like adjustable rate is kind of like what I thought the variable rate was.
Well, it's really the same thing with a different name. It's just it works differently, right?
Mm-hmm.
So they give it a different name because it's not the same. Again, I call it product,
Mm-hmm.
right? Now, again, the next thing is really I focus on is like how are the interest rates determined when you're getting a mortgage? Because this is also very important. There's a lot of misconception that's out there. So anyone who's looking at getting a fixed rate mortgage, the fixed rate mortgages are typically anywhere between 1% or 2% higher than the respective Canadian bond yield. So, for example, if someone's looking at getting a 5-year fixed rate, you have to look at the 5-year Canadian bond yield, and then the pricing typically 1 or 2% higher. Now, the spread will vary depending on the volatility of the bond, the loan duration, meaning if you're getting a 1-year, 2-year, 3-year, 4-year, or 5-year fixed. And also the spread will change based on the risk the bank is taking when issuing the mortgage.
Mm-hmm.
So, there's a lot of moving parts when it comes to the banks offering a fixed rate mortgage to a consumer. They look at all these different factors, and the most important thing for them is that bond yield, because that changes daily.
I know a lot of times when they have that Bank of Canada rate decision that people think that that's going to affect the fixed rate mortgages, but that's not correct. I mean, that's basically the bond yield affects the fixed rate, and the bond yield. Well, sorry, bond yield and the prime rate. I guess that's two different things, but so they don't directly affect each other, but they're interconnected, from my understanding.
There's a slight connection to them, and we'll get as we go along, I'll kind of show some charts, and you could kind of see how it all works. Now, for the purpose of the presentation, I'm going to be saying variable versus variable or adjustable rate,
Okay.
right? Just to kind of for the simplicity, right?
Mhm.
So again, the variable rate or adjustable rate mortgage, the interest rate you receive is typically 2.2% higher than the Bank of Canada. Again, it's actually called the overnight lending rate.
Mhm.
You will, when you get a mortgage, you will receive a discount or a premium of the bank's prime rate, depending on the type of mortgage you receive, whether it's an open or a closed mortgage. So for example, you're looking at buying a home or refinancing, and you're looking to get in a 5-year closed variable. Well, if you're looking at getting a 5-year closed variable, the bank will give you a discount to that prime rate that they're offering you, which is 2.2% higher than that Bank of Canada rate.
Mhm.
Open is kind of like a line of credit. You have a mortgage and you got a home equity line of credit, because you could pay it off in full at any time. The banks typically offer a rate of prime plus, whether it's 0.25, and traditionally on a line of credit it's 0.5.
So they don't incentivize people as much to get those. It doesn't sound.
Well, no, it's just, again, if somebody has the ability, Alex, to pay the loan in full with no penalties, do they necessarily need to give out discounts? When you get a closed rate mortgage, if you want to break that mortgage and pay it in full, they have to pay a 3-month interest penalty. The clients are willing to give out a discount because they know you're going to be a customer of theirs for 5 years. And if you're going to want to leave them early, they will receive a penalty for you, leaving that mortgage.
And it's a 3-month interest penalty.
Yes. If you have a variable rate mortgage, the penalty is a 3-month interest penalty.
So if you break a variable rate mortgage, the 3-month, you mean, but that's if you're going to fixed with a different lender. Or you go to a variable for a different lender, right?
Yes. Let's just say you're leaving the bank, right?
Yeah.
So I just want to kind of show like how interest rates are determined, because again, like you said earlier, Alex, like as the prime rate changes, a lot of people are focusing on, okay, my fixed rate's going to change. Well, it really didn't have an impact on fixed rate mortgages as people think, especially like when as the Bank of Canada will be lowering the interest rates.
Hmm.
So again, when going more specifically into interest rates, now that I kind of explained the two, let's look at from 2000. Like this oldest chart I could kind of find. This is the Bank of Canada, the overnight target rate, and what we call the prime rate. So what's happened? Back in 2000, we're pretty high with just about 5.75%. Dot-com bubble burst. They had to lower the prime rate quite quickly, right? Then it went up a little bit because they lowered it a little too much. And then after a while, the economy was growing. So the economy was growing from say 2002 to 2005. While the economy was growing too fast, the Bank of Canada started raising rates. Because again, that was the time when housing, like more specifically in the U.S. In the U.S., there were what's called like ninja mortgages: no income, no jobs, no documents, no nothing. Right? Everybody and anybody could get a property in the United States until the financial crisis.
This is like the subprime mortgage boom.
Yeah, the subprime, right? It didn't, but because the United States are our biggest neighbors, when that happened, that financial crisis impacted the whole world.
Mhm.
So everybody just lowered rates. And when they lowered rates for pretty much a year, they dropped them to almost zero.
Wow.
They after about a year, the Bank of Canada raised a little bit, but the Canadian economy was fragile because there was like literally trillions and trillions and trillions and trillions of dollars of liquidity that had to be flushed out of the system, that it wasn't done overnight. So even as they tried raising rates, and they kept the rates long for stagnant for almost 5 years, the economy was fragile. They couldn't raise any higher, and the economy actually slipped a little bit. I do remember back around 14, 15, there was I don't want to say like oil crisis, but oil dropped to like $30, $40 a barrel. And, at the time, Canada was really into, the oil patch was a bigger part of our economy than it is today. And again, when Alberta slowed down, it impacted the growth of the nation. like Canada, had a big impact on Canada's growth. So they lowered it just slightly. They kept it down for a little bit. Then they started raising rates again. Because the economy was starting to grow again, normalized. Oil went back up, and we all know what happened in 2020, COVID. So COVID happened, prime rate drops again. We stayed flat for 2 years, and then we all know about this inflation that happened. So, the Bank of Canada raised the variable rate from 0.25 to 5%, and only now we see inflation cooling, and they're starting to lower rates. So it's a little bit of history with regards to the Bank of Canada and prime rates. The Bank of Canada and variable rates move every day. No, they do not. This clearly states that they don't move every day. So anybody looking to get a variable rate mortgage, however, when they do move, you could see they move in swings.
Yeah. Around the economy, and as much as it seems like now or back in 2023 it was really high, it wasn't actually as high as it was in 2001, and then that wasn't as high as it was like in the 90s and the 80s as well, when we had a real estate crash. But it just, the property value was at a completely different price point.
Yes, yeah. So when it comes to fixed rates, it was harder for me to get something a lot further back. I got back as far as this. Let's call it the new year, January 1st, 2022. So you could see, during that COVID period, we had ultra low interest rates. The Bank of Canada, the 5-year bond yields were extremely low, just around, a little bit more than 2.25%, 1.25%. And then afterwards, you could see how interest rates kind of rised. And the peak was actually, in October of 2023. It took over a year and a half for that fixed rate to peak, which is a reasonable amount of time. Since that peak, we see there was a quick drop when at the end of 2023, because the expectation was in 2024, earlier in the year, we would be seeing the U.S. and the Bank of Canada lower that prime rate. Well, it took a little longer. The Bank of Canada didn't lower rates till June. So when at the beginning of the year, when the expectation of the Bank of Canada not really lowering rates in February, March, or April, rates froze a little bit. But once they started lowering interest rates, the 5-year bond yield came down. The better illustrate this is really, Alex, again, the Bank of Canada prime rate and the 5-year Canadian bond yield. So the blue line is the Bank of Canada prime rate, and you can see how it's gone up in that period. And the orange line is the 5-year bond yield. And as you can see, fixed rates did not go up as quickly or as much as the variable rate. And the same thing when it's come to, how they moved over the past year and a half.
Yeah. There seems to be some synchronicity beside it, but not much. And it seems like at one point the variable rate was lower than the fixed rate.
So yeah, over my 20-year career, those looking to get a variable rate mortgage, the variable rate is traditionally lower than the fixed. But there have been times in the past where the fixed rate was higher than the variable, and we're in one of these periods now. The one thing is, again, when it comes to how do they move, I look at it as you can see the fixed rates move first. When the rates are going up, the fixed rates move first. But once the fixed rate got to a certain point, the variable rate continued to climb. And when fixed rates were kind of like the bond yield and mortgages for fixed rates, they were in a range from, let's call it, October 2022 to let's just say the spring or early, May 2023. They were in a range until they broke that range, and they went as high as October. Once they hit that peak, it started coming down. But the Bank of Canada didn't do anything with that prime rate. Fixed rates were coming down without the government changing that prime rate. So how did this happen? Well, I think, Alex, it happens because of expectations. The expectation of the Bank of Canada to move and lower rates.
So like future anticipations gets priced into the market, like in stocks.
Yes, like in a lot of things, like in a lot, if we go to the grocery store, if we think milk will be cheaper this week than next week, we'll buy maybe two gallons versus 1 gallon, right? If we think things are going to be cheaper next week, we won't buy the item today. We'll wait for it to happen next week.
So when people or the market think that, hey, interest rates are so high, they got to bring them down, that is, an indication that it will be brought down. And then when people think like, oh, interest rates are so low, buy, then they start to go up.
Yeah, and
They basically see what people are saying and do the opposite.
Yeah, so the one thing is again, just like when rates are going up, as rates are going down, you see the fixed rates are going down before the Bank of Canada changes.
Mm-hmm.
They're not going down by as much. However, actually, they're actually moving down a little bit faster. They were as high in, let's call it May 2024, just under 4%, and then it broke under 3. Versus that's a 1% different, Alex. Versus the Bank of Canada only changed that variable rate by 0.75.
Right.
So the anticipation fixed rates have already come down faster. So I know a lot of people are, as they're expecting that Bank of Canada lower, well, it's really catching up to the fixed.
Right. It's just getting to where it's supposed to be.
Yeah. So this is a little bit of history, and I've kind of brought it into today's, today's time. So Alex, again, this is kind of what I shared, and I hope everyone learned. First, again, the prime rate doesn't move that often. So when it does, pay attention to the direction.
Mm-hmm.
At the same time, bond yields change every single day and is a lot more volatile than the Bank of Canada prime rate. So if you're looking again a fixed rate mortgage, you can't time that volatility. You can't time the market. It's getting, I guess I call it a ceiling. Okay, this is the highest your rate's going to be, and then for the time from when you get that initial, financing and rate hold, if rates go lower, I help all my customers get the lower rate if the direction is going down. If the direction is going up, well, at least you have security, knowing that this is the most you're going to be paying. You're not going to be paying a higher rate if you waited. At the same time, bond yields tend to move before the Bank of Canada. Doesn't necessarily happen all the time, as we see, but that it's kind of like it's like a leader.
Yeah.
And the one most important thing is in life in general, and especially when it comes to like the market, unforeseen events will always happen, and they change the expected outcome. So those trying to forecast between now and let's just even say the end of this year, there will be some events that will come up that nobody would have anticipated and would have changed everyone's opinion today of what will happen.
Do you think the U.S. election is going to impact our interest rates?
Again, I think it'll impact not just, I think the new leadership in the United States will impact can impact the whole globe.
Yes.
Right. So because they're the biggest economy, and again, they have it just has a lot of influence and impact with regards to the rest of the world. Right. So we don't know who's going to be in office. It could be Republicans, Democrats, but that's a big event. And all those predictions that are out today, if once they know the outcome of that, they may change their opinion.
So where maybe are you going to get to where you think they're going, where rates are going in the future, or like I don't want to jump ahead of you here.
Yeah, no. Well, let's talk about the present. Like, where are we now? We talked a bit more about the past, how things changed in the past. Where are we now? Now, again, the factors that impact inflation, because that's been the biggest thing in the past 2 years: cost of production, price of goods, demand for goods, skilled labor availability, new technology, and the current money supply. These are the main factors that impact inflation. So let's look at today, Alex. Canada's population.
Wow.
This is, as you see from 2012, this chart is, you see population is growing. It looks like exponentially. Ironically, again, we were only coming from like 35 million, just under 41 million. 6 million people did not seem like a lot, but 6 million people over the previous, 35, that's like almost 20%. Right? So that's a big increase. My math might be a little bit off there, maybe not be 20%, but you get the point.
Yeah.
So population clearly is growing.
Yes.
What's next? Ironically, the fight with inflation, we hit that peak inflation, it's coming down, which is really good news.
Where should inflation numbers be? Like, what's the target?
Targets, it's a range, and they call the range is kind of like 2%. If it went to 2.5, 2.7, they'll be a little bit more cautious. And if it went down to, 1.5, they're like, okay, we don't want to go too low. They want to try to keep it, as best they can around that 2%. And one thing that may change in the next decade is 2% target may need to be 2.5%. Why are we so stuck on this 2%? We've had it for many, many years, but that's when we had globalization and we used to import deflation. Now we're bringing a lot of production back home to North America. That will initially drive costs higher. So that's more of my input versus what will really happen. The truth is, so to answer your question, the target, Alex, is today is that 2%.
They may change that. As much as the population has grown, I do think it's going to decrease a little bit, because I've heard that a lot of people, well, maybe it's not going to decrease, but I think it's not going to grow as rapidly as it has in the last couple of years.
Well, I don't think, again, that's where I kind of agree with what we see today, because again, there's always going to be an unknown event. I agree with you that based on today's information, because as you see here, unemployment is creeping up. Now, the COVID spike, again, unemployment, that was clearly a spike, and we know why. The whole world shut down. Everyone was locked in their house for a month or two, right? But as you see unemployment going up, it's going to, relieve some pressure with inflation, because there's less people working, less money going around to chase, the goods that are available to purchase. Right now, the one scary thing is with unemployment going up, it's also going to be like the Bank of Canada needs to lower this prime rate, because they don't want to get unemployment to go too high.
Yeah, they need to get employers to hire people.
Yeah, if lower interest rates, it's incentive for businesses to grow, to buy, machinery, hire, their sales are going up, so they need to hire new people. So there's always going to be a balancing act. But again, if you want interest rates to come down, that means unemployment is going to need to go higher, which that's where it's a balance, right? Like, I am in a variable rate mortgage. I want to see interest rates go back down to that 0%. I'm not willing to have that 0% interest rate if unemployment is going to go up to, say, 10%, Alex. He's going to have no customers to help buy a property or refinance because nobody's working.
Yeah, basically, it's the worse the economy is, the lower the interest rates are.
Yeah,
to stimulate the economy in the other direction. It seems like it's just like a game that they play.
Well, it's not a game, but they're trying to make to put like cushions on both ends of the spectrum.
Yeah, manipulate policy to stimulate growth. Or shrink.
Yeah, so unemployment, I think right now it's at 6.4 or 6.6, which, again, I remember, when I was much, much, much younger, 20 years ago, unemployment under 7% was technically amazing, but our population was way smaller back then. Our economy has grown so much since then is a lot more diversified. I see, anywhere between 6 and 6.5 is kind of like a good unemployment period. The fact that we're going a little bit higher, if we get closer to 7, I'll definitely be a little bit more concerned. So the economy is changing, and interest rates are the Bank of Canada is going to lower interest rates to try to cushion the blow. So unemployment, if we hit 7 for 1 or 2 months is one thing, versus we're over 7% for 6 months, a year.
Yeah, that wouldn't be great.
Yeah, but ironically, Canada's gross domestic product, GDP, I found this very interesting, because last year, with interest rates being, at least the Bank of Canada prime rate, even the fixed rates were at a peak, you could see, we had two out of 4 quarters in the middle of the year on, negative growth. And I'm surprised, Alex, when I got this information, this data, how the Canada's GDP is slowly growing now at 0.4, 0.5%. We're definitely not going. It's not growing at any light speed. However, I was surprised to see, because I actually thought on, GDP would actually still be around that zero. We're close you could get to zero being at 0.5, but again, that's another reason why the Bank of Canada is lowering the overnight lending rate, because they want to stimulate business. They want people to invest. They want people to borrow money, to buy goods, to buy cars, to buy houses, to buy these big products. So, our economy could grow.
What's the target for GDP?
I don't know if there's an official target. They want to see maximum growth with the lowest unemployment and the lowest inflation. There's no official number that I know of when it comes to GDP growth.
So there's like a balance between all three of those.
Yeah.
Yeah. And like too much of one impacts the other ones, and then you increase another one to stimulate the first, and they just kind of go back and forth and back and forth.
That's exactly it.
Yeah.
So that's the present, Alex. I kind of showed this already, how you see the present, the Bank of Canada is starting to lower the rates.
Mm-hmm.
And same thing with the 5-year bond yield. They've started to come down, which is, again, trend is your friend, is what I kind of say. I got that term from the stock market. So, what do we learn from this? Hopefully I shared and you all learned the factors that impact our economy. Our population is growing. The cost of goods are coming down, i.e. inflation. Also, currently, unemployment is rising, which is not really the best thing. And that's kind of one of the reasons why the interest rate trend is coming down too.
Mm-hmm.
So, Alex, you asked about the future.
Mm-hmm.
This is where it's kind of like the future is an unknown thing. Doing mortgages for over 20 years, it really comes down to where are we in the economic cycle, right? The economy constantly, if you're looking at buying a home today, or if you're currently in a home today, we're going to go through different phases, which is expansion. We're going to hit a peak. The economy is going to contract. We're going to go through the bottom, then we're expand, peak, contract, and it's a cycle. I think we're clearly, when it comes to the contraction, if we're not at the bottom or close to the bottom or at the bottom and slowly coming back up, it's tough to say exactly where we are, because hindsight's always 20/20.
Yeah.
Right. But we all agree we're not at a peak. The economy has already slowed down, as we showed. It's exactly where are we? We're kind of near the bottom.
Right.
Alex, again, now I kind of put a layover with regards to, this is just a 5-year Canadian bond yield graph from the 1st of January 2022 to the present. And I've also added a yellow line, which is a 20-day, the average of what the 5-year bond yield is for the past 20 days, which is in yellow, and it's orange.
Mm-hmm.
So looking at this, we know, when rates went up from 2022 till, let's call it, near the end of 2023, see rates are coming down, but where are they going to go? I left some space on the right to see, like, do we really know where they're going? When you look at this, where would you think they're going?
I mean, I would think they're going down, but it's when I look at this and I'm thinking about, like, looking at stock graphs, I almost see like a resistance in the 2.8 range, because I see that it hit that 2.8 mark a few times and it kind of has reversed the other way. So I think that probably with all the information you provided, they're going to go down some more, but I don't know how quickly. I think they'll go down. Maybe they'll go up a little bit, down, up, and just kind of, work its way. But we'll have to see. Like the economy will be the true indication, right, of the GDP, the unemployment numbers. That's going to give us a true indication of where we're at. So you have to constantly measure this. And like the Bank of Canada likes to say, they don't like to commit to anything. They're always just like, we're taking it one meeting at a time.
Well said, Alex.
Yeah.
You're right. We look at interest rates, and even I'll put myself even in that basket, because at times I'm just looking at the present. As I look at interest rates, I'm more looking at the more current items. But when you look at the even a 3-year history to put in perspective, for interest rates to go below that the 5-year Canadian bond to go below that 2.8 or even like 2.7, 2.6, that's kind of like, we tried many times when rates were going up and they couldn't go lower. Now, obviously, a lot has changed. Inflation is no longer going up versus back then inflation was still going up. But again, if you at the very end, Alex, this little blue line at the very end, this is literally the past 2 business days. It's a very big spike up from 0.28 to let's say 3%, a
Right.
0.2% increase in the 5-year Canadian bond yield. So guess what's happening in my inbox with the banks emailing interest rates in the last, what's going to happen today, tomorrow, or the next day?
They're going to be emailing you, like you have lenders sending you updates on what
Yes.
their rates are.
And is that rate going to be the same, lower, or higher?
Higher, most likely, because it's going higher here.
Yes. So when there's big shocks and kind of both direct, when rates go down, the lenders are always slow. They'll wait an extra 4 or 5 days before they start lowering them. But when they go up, let's all agree, the bank's business is to make profit. And if their profit's at risk, they're going to focus on their business more than consumers. Right? So this is a quick spike in the last 48 hours. I will be seeing my inbox being overloaded with a lot of emails from all my lenders saying price increase, and it comes without notice, right? I would love to say it's going to happen tomorrow, maybe the following. I'd love to say it's going to happen next week or not happen at all. But when I see this, okay, I know when I wake up in the morning or throughout the day, I'm just going to get a bunch of emails from my lenders. Take a quick look at it to see if there's a change, right? So when where rates are going, there's going to be unknown events. The presidential election, what's happening in the Middle East is very concerning. We saw oil went from like 68 to 77 in like a week and a half. And today, oil, I took a look at it even before this webinar. It's dropped like at one point today $4. So that means tomorrow when I go to the pump, it's going to be cheaper or not. I don't know. But there's so many other events that are going to happen. We really don't know what's going to happen. We really don't know the long term now. The trend is your friend. In the coming weeks or months, I'm confident to say the trend may continue down. It may not be this quick. It may be a little bit longer. It may be a little bit slower. But I like to believe that with the economy slowing down, unemployment going up, the outside factors are going to start having a much more impact to our economy, that they'll need to lower the prime rate, and the fixed rates and the bond yields will follow suit. Like they may lead or be a leading indication if they go down.
Right. So if you were to get a mortgage today, what would you be getting? Variable or fixed rate?
Well, again, that's a good question, because I get that question asked every new customer I talk to.
Right.
It really comes down to, what are you borrowing the money for? How long are you borrowing the money? If it's your first home, and it's a starter home, you may not want the long 5-year fixed rate, because again, there's a good chance, I see with a lot of first-time buyers, within the first 5 years, between promotions, getting a new life partner, changing jobs, and higher pay, they'll be breaking that mortgage to get into bigger property.
Yeah, I heard that like 60% or something of people break their fixed rate mortgage early.
Yes.
So speaking of that, with the rates and where they are today, are you seeing clients that are like, maybe they renewed a year ago and now they're breaking their mortgage to get something at a lower rate? And if so, like, does that make sense? And I know you mentioned that to break a variable rate mortgage, it's 3 months of interest, but what is it to break a fixed rate mortgage?
To break a fixed rate mortgage, the penalty is the way it's written is it's either a 3-month interest penalty, or it's called interest rate differential. And to explain it in English versus the bank language, it's how much money is the bank losing if they have to reinvest that same amount in the mortgage based on today's interest rate. How much money are they losing because today's rates are lower? It's the greater of the two numbers.
Okay, so it sounds like something that you can't even calculate.
You can't calculate it unless we know what, especially like those who want to get that mortgage down. So like, what could the penalty be 2 years from now if I need to break it, or 3 years from now if I need to break it? Well, nobody could calculate it because we don't know what that interest rate's going to be in 3 years from now.
But I guess if somebody was to go and break it, their bank would tell them, right?
Yeah, again, I'm working with people now where, again, you get a penalty quote, and even before you do anything, does it make mathematical sense? Just because the rate's lower, you need to know your savings is significantly larger than the cost for breaking. Like if it's going to cost you $6,000 to break and you're only saving $8,000, is it really worth it?
If it costs you $6 to break and you're saving $8,
Yes.
well, it's $2,000.
True, but you're also going to be paying interest on that extra money because you're going to add that to the mortgage, right?
Right.
You balance it now instead of going down. Now, if it costs you $6 to break your mortgage and you're saving $12, different story.
And when somebody goes to break their mortgage, like if I'm breaking it with A lender to go to B lender, do I have to have money to pay A lender to do that, or what happens?
Well, again,
Or does B lender pay it?
a lot of times, as long as there's equity in the home, we could just add the penalty to your mortgage balance. Now, if you have the money to pay out of pocket, that would be encouraged because, again, you don't be paying interest on something you don't need to. Right. So it's really, so what rate people are choosing. Actually, Alex, I'm also, to kind of play the other side, I'm actually working with some savvy people that they're anticipating the both variable and fixed to come down. And their logic, and when I talk to them, is the logic is some of them are taking variable, not because they're going to stay variable for 5 years.
Right.
It's because they know they can switch that variable rate to a fixed rate to when, say, that Canadian bond yield go down to 2.4 or 2.2.
Yeah.
Right. So there's nothing wrong with taking a variable rate today because we know the trend is down. We don't know how low it's going to go.
Mm-hmm.
As long as you're doing it for a short period of time, let's just call it 6, 7, 8 months maximum,
Mm-hmm.
then you're locking it in at a lower fixed rate than it is today. It's a good idea. The truth is, nobody knows where rates are going, and I don't like to be somebody to say this is where rates are going, because it's really, for me to say interest rates are going lower really benefits me. It's a sale. I'm not here to sell. I value relationships over transactions.
Right.
So I really choosing the rates with the people I work with. I like to more analyze their scenario, listen to them and have them explain what they're thinking, ask them a few questions. Then by the time we go over it, they're the ones coming up with the answer. With
Right.
5-year fixed, 3-year fixed. Some people have actually asked me for a 10-year fix, which I don't think is a great idea nowadays. But it's really choosing an interest rate is choosing whatever makes sense for you, not based on what social media is going to say, or online television, Googling interest rates and other people's opinions. These other people's opinions, Alex, is really going to be what benefits them. They're selling. They want to get more hits on their social media, TikTok, Instagram, so more people follow them, more people view them. Is it really what, is it connecting to you?
Is what lenders are offering, the rate, let me rephrase this. Is the rate that lenders are offering for different terms of mortgages an indication of where they believe the rates are going? So for example, I see that lenders are offering a 1-year fixed at like substantially higher than a 3-year fixed.
So no, the lenders are not, their interest rates they're offering are not based on what they're indicating. It's based on that spread. At the beginning, I kind of mentioned the fixed rate is usually 1 to 2% higher than that respective bond yield.
Mm-hmm.
You put a chart of a 1-year bond yield, the yield would be higher, right? So,
okay, I understand.
So as the bond yields change, because everyone they move at different rates,
right?
So where we are right now, again, hard times create strong people. Strong people create good times. Good times, Alex, tend to create weak people. They get complacent and think, they take granted for what things they have, and weak people create hard times.
And it's all a cycle.
Yeah,
that repeats itself throughout history over and over again. This
has gone on since the beginning of time.
Right.
So that's really all that I have for today. What are your thoughts? Have you learned anything?
Yeah, I mean, especially the variable rate versus the other rate. I'm going to stop the recording, but yeah, the variable rate versus the what was the other rate called? The other adjustable rate. Yeah, that was interesting. And then also just to kind of see historically, where rates have been and how it kind of moves up and down. It kind of gives you like, it doesn't make it seem like it's a random event. Let's put it like that.
Yeah.
And what about the trends in terms of the sales between the rates dropping? Like, has there been more sales, or more properties being put on the market than as the rates, or are people still sitting on the sidelines?
So there's some rules that are being brought in, right? So one notable one is the increased rate cap. Sorry, not rate cap. Cap for the insured mortgages from 1 million to 1.5 million. And then also the market is anticipating future rate drops as well. So what I'm seeing, Gordon, is that, what I'm seeing, David, is that I'm seeing sellers that are bringing their properties to the market because they want to, historically the fall market is one of the busier times. But at the same time, because people are waiting for that December 15th change for the insured mortgages from 1 million to 1.5, properties are just kind of taking, like, they're just sitting there because if somebody's shopping in that $1 million range, okay, they can buy a place for 1.1 million today and put 20% down, or they can wait 2 months and put 10% down.
Gotcha.
So the policy changes is kind of what's, in my opinion, affecting the market. But what I think is going to happen is that eventually this market is going to shift, and it's going to go from pretty much a buyer market like it is now to just like a frenzy seller market. So what I am seeing now is I'm seeing a lot of investors getting into Toronto real estate. Like, investors have kind of been out of, like, for example, condos, especially for the last 2 years, just because it didn't make sense with the interest rates. But I see investors are coming back, buying condos now, kind of trying to capitalize now on the lower price points, because I think that spring 2025 is going to be busy, just because like, people will be, rates will be significantly lower than they are today. And then all this additional policy change is going to just add so much stimulation, and our population continues to grow, as Carmelo showed. So, first is going to be the freehold properties that are going to start to increase significantly. And then eventually the condos, because there's always, like, there's that spread between what is the cost of a condo versus the cost of a freehold. And then when, freehold becomes significantly more than a condo, then people start to kind of scale down about their expectations of what they're going to be getting. So then they start to drive demand to condos, and when all the excess supply is going to get absorbed, then it's all going to be we're going to be in a seller market for both. But just like I was doing a video today for my YouTube channel, like not the Level Up one, but my personal one, I started to do like long form videos about different things I'm seeing in the market. And I saw a condo at Yonge and Eglinton, where in May it was listed for $525,000, and then it sold in September for $385,000. So it's like $150,000 difference, and that just kind of shows you where the market is when it comes to that. But eventually, like, this is good. Somebody got a really good deal, right? Like, it's just a studio, but still, I mean, it's still good for an investor. So I think that eventually, between end users and investors, all the supply is going to get eaten up, and then we'll be back in seller market territory, especially. And just to add to this, a lot of new construction has been getting canceled this year or postponed, because it's like $1,500-$1,600 a square foot for pre-con versus $700-$800 for resale. So because these projects are canceled or postponed, what's going to happen is all this stuff that was supposed to finish in 2027 is now not going to get finished in 2027. It's going to be finished like in 2030. So it's going to be, I mean, you can see the writing on the wall. I think what's going to happen here. It'll be busy. Yeah.
What do you think is going to happen, David?
I don't know. I'm just like, what I've seen is that things are moving slightly, but they're not moving aggressively. Like, yeah, I'm not seeing them. Like, just looking around my neighborhood, I'm seeing things move, but not a lot.
Are you in the GTA?
Pardon me?
Are you in the GTA?
GTA, yeah, in Toronto. I'm seeing things like, and so what that makes me think is, it's, if you have to move, you have to move type of thing. Like I don't know, you have a kid, you need more space. So that's how moving. But like a few months ago, nothing was selling. So you have to move, but you can't move because no one will buy your place. Whereas they will buy your place, I think now, but you're gonna have to, reduce your price.
Always comes down to price. There'll eventually be a price point where the realtors will just start buying the property. So, like, you know what I mean? But a lot of times people don't want to sell at that price, obviously, right? They
yeah. And then, like as you said, that Eglinton condo where the person sold it at like 150, 150 loss. Like again, over time, if they buy another house and they eventually make a profit later on, then I mean, it's a good deal.
But just some people are in a tough situation. There's a lot of power of sales too. Like I saw.
Oh yeah, I'm seeing that too. Yeah, like
yeah. There's something like 200 power of sales on Treb right now, which is like an all-time high. So a lot of that happening as well. So like that's what I'm saying. Like
but that's the investors, right? That's the investors got in and it got too expensive to keep the property.
Mostly.
Like your mortgage wasn't, it was too high.
Yeah, mostly that's what it is. Yeah. But I've seen some where also like, people bought bought the place like 20 years ago, and then now it's being power of sale now. And what I think happened is they kept taking equity out, right?
Mm-hmm.
And that's so it's basically like, just people that got in at the wrong time or over leveraged or thought that the market is gonna continue to increase no matter what, right? Like it's just the same thing that we're seeing with assignments as well, right? Like people are desperately trying to get out of assignments. In some cases, they're walking away from their deposit to the builder, just like to end the pain. Like they're willing to walk away from like $80,000-$90,000 that they've given the builder just to not close on it, right? So it's it's I don't know. I think it's a good opportunity for anybody who has equity or liquidity to get into something. It's a good time.
And they're going to stay in for a number of years as well.
Oh, for sure. At least 5.
They're going to get into it as like being a landlord buying various properties and not putting up because of capital gains, right? So
100%, man.
But okay. Yeah. But one would think that I was hoping that it was going to be like the rates drop big time, and then all of a sudden it starts up again, being the fall. But it really hasn't happened that way.
I think, David, people are still waiting for rates to come down, and that expectation is almost every single person I'm talking to, especially the first-time buyers. Everyone asks me, like, well, the bank came to they lowered that prime rate again in October by 0.5%. They're all saying 0.5%, when truly we don't know what's going to happen.
Yeah,
they're thinking the fixed rate's going to come down 0.5%, which clearly historically has never happened that by that same ratio. So the expectations of what's going to happen, and also these new rules coming in, that's going to be a game changer for next year. Like there are a lot of first time buyers that they have husband wife combined income 250 300,000. There's not a lot of them, but there's a good handful of them. But they're capped because they don't have that 20% down payment to buy for over $1 million. To have support, with their savings and support some family to put, say, that minimum, or let's call it 10% just for now, on that 1.1, 1.2, where they easily would have qualified, where before they couldn't.
Right.
So there's a lot of people are actually waiting.
But what about rents? Or if rents are going up, then it might be a good time to get into the market.
Yeah. I think it's time in the market, not time in the market, but this is probably the one times I would say you got to time the market. It seems like the golden spot. We'll find out 6 months from now. Hindsight's always 2020, but the stars are aligning. The rates are coming down. Buyers aren't really coming out. You can still make offers with financing condition, home inspections. You can still put some conditions on it, and you're not bidding against 10 other people. At most 1 or 2 if you're buying a freehold in the right neighborhood.
It's scary. It's scary.
Yeah.
But it's like if you're in that scenario, you're just like, I gotta take it.
If you gotta sell, you gotta sell, right?
But if you gotta sell it, you gotta it's just like you gotta go for it because you don't know if you're gonna get another one.
Yeah, exactly. You have to really work with any offer. So yeah, that's what's happening. So we'll see what I don't know. My prediction is that spring 2025, it's all gonna go back to how it used to be before.
Oh, that's amazing.
Yeah, I think in spring, rules will be out. The rates will be, may not maybe significantly lower than today, but they will be fixed in a variable.
Or what about Christmas or something like that, like in the winter, where it's a bad time, where you see people like, getting deals and things like that, just because it's like,
Yeah, that is Christmas. Yeah, exactly. Yeah, that's like that's not a great time.
That's desperation. That's more probably people like that have to move type of thing.
100%, man.
Well, thanks for joining us today, David.
Yeah, thanks. I like this time spot. It was interesting. But maybe other people. I don't know.
Yeah,
I'd say I'd just keep mixing it up.
Yeah, we're gonna try it out. Just we want to